Hello, welcome to Thinking Post Training. My name is Ivan and I'll be your guide through this question. This is the BDA December 2023 paper, question 21. We are required as per IAS 1 to prepare the statement of profit and loss and other comprehensive incomes for the year ended 30th June 2023. To prepare the statement of changes in equity for the year ended 30th June 2023, and then to prepare the statement of financial position as at 30th June 2023. Our question reads, Fanisi Limited, a listed company, has provided the following trial balance as at 30th June 2023. So we have revenue, which is income, purchases and expenses, inventory is a current asset, distribution costs are expenses, administration costs are expenses, interest on loan stock, this is an expense. We'll have to check to make sure that this interest is the full interest paid. We have rental income, which is an income, land and buildings, which is an asset, which is also reduced by the amount of accumulated depreciation, plant and equipment, an asset, investment property, an asset, trade receivables, current assets, cash and cash equivalents, current assets. We have ordinary share capital, this is capital, share premium, also capital, dividends paid, capital, rather they reduce my amount of capital, my retained earnings, capital, my general reserve, capital, my loan stock, this is a current liability, my trade payables, my loan stock is a non-current liability, my trade payables are a current liability, and my proceeds on the sale of equipment, this is an amount of cash. Then I have my additional information. So I'll begin my working, separate out my work, call this my contract. I'll leave space to present my statement and I'll have my workings from here, working 1. So further information to be taken into account, inventory is provided at 97 million at cost and 95.25 million at net realizable value. So inventory should be valued at the lower of cost or the net realizable value. So inventory you can say valued at lower of cost or net realizable value. So at my closing inventory will be 95 to 50. Then at the beginning of the year, Fanisi Limited disposed of some old equipment for 1.7 million. The equipment had cost 3.75 million and accumulated depreciation brought forward at the 1st July 2022 of 750,000. Here we have to find the gain or loss on disposal. So what's into gain or loss disposal. We'll need the cost, which is at 750. We had the accumulated depreciation, which is 750, which gives rise to the NBV from disposal, which would be the sum of these two. But then I only got 1750. So the cash proceeds of 1750, meaning we had a loss on disposal of this minus this, an amount of 1250, which is an expense. Then we are told there were no other additions or disposals to property, plant and equipment in the year. Next, the company classifies depreciation on plant and equipment as a cost of sale and on land and buildings as an administrative cost. Depreciation rates are as follows. For buildings, straight line over 50 years, and for plant and equipment, 20% on existing balance. So option 3, depreciation. We have buildings. So first we need to find, we have land and buildings having a total value of 210 million. Then we have buildings alone, which is what is subjected to depreciation. We don't yet know the value. Then we have accumulated depreciation on buildings, which we are given as 30,000. Then we can find the annual depreciation. So we are further told that Fanisi Limited accounting policy is to charge a full year's depreciation in the year of an asset purchase and none in the year of disposal. Fanisi Limited's land and buildings were 8 years old as of 1st of July 2020. So this accumulated depreciation is for a period of 8 years. If I wanted to find the annual depreciation, given this is straight line, I would divide this by 8. Find an annual depreciation of that 750. And if I wanted to find the value of my building, I would multiply that 750 by the useful life of 50 years. So my depreciation will be that 750 going to my administrative costs. Then I have for my plant and equipment, I have a cost of 64,500. But then I disposal an asset worth 3,000, and more than that, I had my accumulated depreciation given as 31,500. So then my current net value is the sum of all this. Then I have depreciation at a rate of 20%. So this should be equal minus 20% of 30,000, which gives me my closing net income. So the sum of these two give me 24,000. So this 6,000 should go to my cost of sales. And then told that on 30th June 2023, the company revalued its land and buildings to 190,000, including 2.5 million for the land. The company follows the revaluation model of IAC for its land and buildings, but no revaluations have been carried out. The company wishes to treat the revaluation surplus as being realized on disposal of the. So we have option 4, revaluation gain loss. We'll have land and building. We'll have the current value, then the value, and then the gain. So the current value of land is 210 minus 187,500. The current value of building is 187,500 minus 30,000 minus this year's depreciation of 750. The sum of which is 176. But the new value has a sum of 190,000. So that the total gain or loss is a gain of 13,750. If you were to separate this between the various elements, you already know that land has a gain of 2.5 million as given by the examiner. So that then buildings have a gain of 13,750 minus 2.5. So the new value will be the current value plus the gain, which will add up to 190,000. This will go to our other comprehensive income. We also told the expected credit loss, which is an administrative expense, is on average 10% of the trade receivables. So working file, expected credit loss. This would be a first time allowance since it was not there in the trial balance. So I'll have the expected credit loss, which should be 10% of our receivables. So 10% of our receivables being 130,000. We'll carry this as an expense, but we'll also reduce our receivables by the same amount when we present our statement of financial position. Then we will The income tax charge for the current and the deferred tax for the year is estimated to be 11.25 million, of which 4.25 million relates to future payable tax and the revaluation of land and buildings to be charged to other comprehensive income. So the revaluation surplus and the deferred tax relating to that revaluation surplus will appear in our other comprehensive income. So we'll have what we take. Our tax is comprised of the current tax and the deferred tax, which is 4250. So this should add up to 11250. So the current tax is 11250 minus 4250, an amount of 7,000. So then we have on 1st of January, Anisi Limited made a 144 bonus issue, capitalizing its general reserve. This transaction had not yet been accounted for. The fair value of the company's shares on the date of the bonus issue was at 7.5 per share. We have a bonus issue making 7 bonus issue. We have the ratio, which is 1:4. We have the share price, which is at 7.5. First, I want to find the number of total shares, which will be our share price or our share capital of 25 million divided by a price per share of 37.5. Then I want to find the number of bonus shares issued. So I was told that for every 4 shares, I will issue 1 extra share. So the bonus shares will be this times this divided by 4. Then I can find that value. So the amount will be capitalized will be the shares to be issued multiplied by the share price, an amount of 62. Then I am told Anisi Limited uses the fair value model of IAS 40. The fair value of investment property as at 30th June 2023 was 147,000. We need to find the fair value gain or loss. Fair value gain or loss. We have the opening value, closing value, so we already know the closing value is 147,000. Our opening value was investment property 1,7,000. So we have a fair value gain. This minus this 10,000, which is an amount of income. Finally, we have to check our interest to make sure we have paid the full interest. So 49 loan interest, loan stock interest, we need the loan stock amount, and then the annual interest. Our loan is worth 7,500. It's an 8% loan, so my interest should be 8%. 8% of that 7,500, 3,000. It should be my expense, but then I had paid loan stock interest paid, had paid an amount of 1,500, meaning I have a loan stock interest payable an amount of 1,500. 3,000 minus the amount paid, 1,500. And that will be it for my working. I can now present my statement. So, I can say limited. My first requirement was a statement of profit or loss and other comprehensive income for the year ended 30th June 2023. I will start with my income or my revenue, which is an amount of 162. I can less my cost of sales, which will involve my opening inventory, to which I will add purchases, to which I will also add the plant and machinery, plant and equipment, depreciation, which was 6,000. Then I can less the closing inventory, which is 95 to 50. This should give me my cost profits. That is when I subtract my total cost of sales, which is the sum of all this, from my revenue. So it should be negative. I should find my cost profits. Then I can have the other income, which I have rental income of 12,000, and I also have this fair value gain working 8 of 10,000. It would be a good idea to mark out the values you have already used, just to be able to keep track of the values that you're given. Then this will give us our net income. It will be the sum, this and this two, which will then subtract our expenses. Our expenses include, we have distribution cost, we had no adjustment to the same, we had administration expenses, which include the amount in the trial balance, my building depreciation, and also my expected credit loss. Then I have interest on loans paid, which has an adjustment to 3,000. Then I have nothing else in the trial balance. Should check my working. I have this loss on disposal. An amount of 1250. Let's mark this value. Then I have this already included. This is already included. My tax should be net. I think that will be it. From here I can find my operating profits, which would be the sum of my expenses subtracted from operating my net income. So this would be the sum of this and this. Then I will have my current stuff. Which will be an amount of 7,000 to give me my net profits, which is the sum of these two at 14,750. So I made a small error here. This value should be positive. So we have a net profit of 27,250. So from this net profit, we add other comprehensive income. So that to this net profit, we will add other comprehensive income, being our revaluation surplus, an amount of 13,750, and our deferred tax, an amount of 42, the sum of which is 9,500. So our total comprehensive income is the sum of this and this, an amount of 12,250. This is our P&L. Can then present our statement of changes in equity. In this case, we want to pick out our equity elements being share premium all the way to general reserve. We want to transpose them here. We write this and shorten this. But then I have a new element of revaluation surplus. And finally, my total. So I'll have the balance brought down. Again, actually I'll remove the dividends paid and consolidate my label. So I'll pick out my values. My share premium at a value of my ordinary share capital unit. The share premium had a value of 61. The retained earnings had a value of 188. The general reserve had a value of 152. I had missed my ordinary share capital. I'll add that here. In the label and the value. Then I have to now add the transactions during the year. I have first my total comprehensive income, of which 2750 will go to retained earnings and 9500 will go to my revaluation surplus. This should be the sum everything here. Then we also had dividends. Dividends will be paid from the retained earnings, amount of 6,500. We also have the bonus issue, of which we will add 6250 to ordinary share capital, and from my general reserve deduct the same 62. So then I can have my balance carry. This would be the sum of everything from the top. carry that across. Then we can finally present our statement of financial position. I'll start with my non-current assets. I know I have land and buildings. I know I have plant and equipment. I also know I have investments, property. So my land and buildings had a value of 190. My plant and equipment had a value of closing value of 24,000. My investment property had a closing value of 147,000. Just to make sure I'm on the right track, I'll mark out my values. I've used all of this. And here, I have used my investment property. These are weighting, income it. I have my current assets. Being I have my receivable, cash and cash equivalent. My receivable should be reduced by the amount of expected credit loss. More on this, I have my closing inventory. Which should be picked out as positive value. And then this will give up my total assets, being the sum of everything from the top. Then I can find the equity, which would be these values here, transpose here, make sure to type in. Then my values here would be formularized one after the other. Then we can have our non-current liabilities. It will involve the loan stock, at a value that is 7,500, and my deferred tax payable coming in at 4250. Then I'll have my current liabilities, which will involve my payable with a value of 108,500, my current tax payable with a value of 7,000 here, my loan stock interest payable with a value of 1,500. Then I can find the sum here in the total equity and liabilities being sum of everything here. And there we go, our work balances. So this is what was required in that question. Thank you very much. I'll see you in